So, 2025, what a weird year for energy, right? On one hand, demand was through the roof, but on the other, prices were tanking. It was a total paradox. So the big question is, how did the giants of the industry, we're talking Aramco, Chevron, BP, actually handle this mess? Well, we're going to dive deep into their playbooks, pulling from some amazing analysis by HDIN Research to figure out who came out on top, who stumbled, and what we can learn from it all. I mean, look, if you just glanced at the headlines, 2025 seemed like a party for the energy sector. Global demand shot up to a record high. We're talking over 104 million barrels a day. With numbers like that, you'd think every single major player was just rolling in cash. It's a no-brainer, right?
Well, not so fast. That's not exactly what went down. The real story is, way more complicated. That record demand, it absolutely did not mean record profits across the board, not even close.
And here's the kicker, the big twist in the story. The average price for Brent crude, it actually dropped, fell almost 15% from the year before, landing at just over $69 a barrel. All of a sudden, there was this supply surplus, and it created this classic textbook case of profitless growth. You're selling more than ever, but you're making less money on each barrel. Ouch. So you've got this pressure cooker of a market, right? And what happens under pressure? Things start to crack, to change. It didn't hit every company the same way. In fact, it created what the folks at HDIN Research are calling the Great Divergence. Basically, a massive split where the energy giants started taking wildly different paths just to stay afloat. And that's exactly what we're going to unpack today. Okay, so here's how we're going to break it all down. First, we'll look at the titans. Think scale versus agility. Then we'll get into the painful pivot of the transitioners. We'll touch on the squeeze facing regional players, follow the money into R&D, and finally, look ahead to what this all means for 2026. All right, let's kick things off with the heavyweights, Aramco and Chevron. You've got two of the absolute biggest players on the field. And get this, they're making completely different bets on where energy is headed. It really boils down to one thing, a battle between pure, brute force scale and nimble financial agility. And this really says it all, doesn't it? On the one hand, you have Aramco's physical footprint, just massive, a true monument to scale. And then you've got Chevron's playbook, which isn't about building bigger, it's about buying smarter, using these really strategic acquisitions to literally purchase growth. So let's spell it out. Aramco's game is all about leveraging its insane scale and dirt-cheap production costs. They're the ultimate cash cow, right? Pumping out cash flow and offering rock-solid stability. Chevron, on the other hand, is playing a different game. They're being agile, making these huge M&A moves, you saw it with the Hess deal, to find pockets of growth in what's otherwise a really tough market. It's a riskier play, for sure, but with much higher growth potential. And when we say scale for Aramco, we mean scale. Just try to wrap your head around this number. In 2025, their total production was 12.9 million barrels of oil equivalent every single day. There is literally no other company on Earth that can even come close to that. And this is their superpower, their secret weapon, an upstream lifting cost of just $3.51 per barrel. That's not just an advantage, it's a giant, unbreachable economic moat. It means they can be wildly profitable even when oil prices are in the gutter. Okay, so now let's flip over to Chevron's agile strategy. They're not just sitting back and relying on what they've already got. Nope, they're out there buying new, shiny assets. And that Hess acquisition, what a chess move. It instantly boosted their proved reserves by 8%. And more importantly, it gave them a huge foothold in two critical areas, the super high growth Permian Basin and those incredibly exciting new projects popping up off the coast of Guyana. All right, let's shift gears to our next group, the transitioners. We're talking about companies like BP. And as HDIN Research puts it, they are going through a painful pivot. I mean, they're trying to steer this massive legacy oil tanker towards a totally new destination, the energy systems of the future. And let me tell you, that is an incredibly hard thing to do. And really, what says pivot more than this? BP is practically shouting from the rooftops that they are not just your grandpa's oil and gas company anymore. They are actively, aggressively building out brand new businesses in areas like EV charging. Make no mistake, this is a complicated, super expensive, and yeah, pretty risky transformation. So how do you pull something like that off? Well, for them, it's this incredibly delicate balancing act. It's like they're taking money out of one pocket, the cash they get from selling off old school assets, and putting it into another, making what they call disciplined investments in the businesses they believe are the future. So here's what that looks like in the real world. Step 1. Divest. In 2025, this meant offloading things like their U.S. onshore wind business and a huge $6 billion chunk of their famous Castrol brand. Okay, step 2. Reinvest. They took that pile of cash and funneled it straight into their new growth areas, things like building out that EV charging network and getting green hydrogen projects off the ground. And we are talking serious money here. They are not messing around. In 2025 alone, BP poured $2.3 billion into these new transition businesses. So this isn't just some PR campaign. It's a fundamental reallocation of capital. It's reshaping the entire company from its very core. Okay, but let's be real, not everyone in this game is a global titan like Aramco or BP. So let's zoom in a bit and shift our focus downstream to refining and petrochemicals. We're going to look at the regional players. A company like Thailand's IRPC, for example. They're specialists, and in 2025, they got caught in an absolutely brutal profit squeeze. See, while the big guys were wrestling with lower oil prices, companies like IRPC were getting punched from a totally different direction. The problem? A massive flood of petrochemicals coming out of China, creating huge overcapacity. This just hammered their profit margins and, well, it pushed them into a loss for the year. The key difference here is that unlike the integrated giants, they don't have big upstream oil profits to fall back on. They were totally exposed. And this chart right here, it just lays it all out so perfectly. This is the great divergence in a single picture. You've got Aramco, the unshakable cash cow. You've got Chevron buying its way to growth. Then there's BP fighting tooth and nail just to break even during its pivot. And finally, poor IRPC, taking a loss. 4 very different companies, 4 wildly different results, all in the exact same market. So these different strategies, they're not just about surviving 2025, they are all about winning the future. And you know the best way to see where someone's heart is? Follow the money. So let's do that. Let's dig into the big bets these companies are placing on tech and R&D. And, no surprise, the divergence continues right here in their R&D spending. You've got 3 totally different velocities. Aramco, they're going deep on high-tech, AI, quantum computing, all to squeeze every last drop of efficiency out of their massive operations. Chevron's bet is different. They're betting on the ingredients of the energy transition. Securing all this land for lithium, that's a play to control a crucial piece of the battery supply chain. And BP, they're betting on the end user, pouring money into things like green hydrogen and EV charging, basically hoping to own that direct relationship with the customer in a low-carbon future. Okay, let's pull it all together now. We've seen these different strategies, different profit levels, different R&D bets. What does it all mean? What's the bottom line for the road ahead in 2026? You know, there's a line from the HDIN Research report that just nails it. They said 2025 is a key year for energy giants, shifting from a high oil price bonus period to an operational efficiency-driven period. And that's it, right there. The party's over, that era where you could just ride high oil prices to easy profits, it's done. 2025 was the turning point, and now for 2026 and beyond, it is all about being efficient, having a clear strategy, and executing perfectly. So that leaves us with the million-dollar question, doesn't it? As we look ahead, who's got the winning hand? Is it the low-cost giant, the agile deal-maker, or the bold company trying to reinvent itself? The truth is, in a market this fragmented, maybe there isn't just one right answer. But one thing's for sure, we're about to find out. Now, all of this analysis comes from the fantastic work done by HDIN Research. If you really want to geek out on the data, I highly recommend you check out the full white paper on their website. Thanks so much for tuning in.